Hello, everyone. It is Wednesday evening at 8 p.m. Eastern. And you know what that means? Probably something good on TV that you can be doing right now. No, just kidding. It is another weekly edition of Taxes and Retirement Live. Thank you for joining me. I am, wait for it, Andy Panko, owner of Tenant Financial and one of the moderators and admins of the fabulous Facebook group Taxes and Retirement. Thank you all for joining me. Tonight's topic, as the signage says, is bonds. Now, the formal title I gave this was something along the lines of like bond prices and why bond prices move or something like that. But I want to make this a little more general. I will get into how bonds are priced and show the fundamentals behind it and why that matters and why interest rates are such a big thing when it comes to bonds and bond prices. But there's a lot to pack in. Bonds are a lot more complicated than stocks in many ways. People know a lot less about bonds generally. Bonds are no less important than stocks or other more commonly known investments. But so there are a lot of ways we can go with this. I made some slides that have some spreadsheets or a spreadsheet. Hopefully you all find it interesting. All right, before we get going, let me, as always, do the dad jokes. I have a spouse theme tonight, a wife theme tonight. These always make for good dad jokes. First, where am I? Here I am. My wife asked me to put ketchup on the shopping list. Now I can't read anything because it's slathered and covered with ketchup. I thought that one was good. And next, so my wife and I go to a therapist. The therapist asks, "So what brings you two here today?" My wife says, "It's impossible to live with him. He's too literal." I say, "My truck." Get it? Because my truck literally brought us to the therapist, and my wife does not like me because I'm too literal. And finally, my wife yelled from upstairs and asked, "Do you ever get a shooting pain across your body, like someone's got a voodoo doll of you and they're stabbing it?" I said, "No." She said, "Well, how about now?" Anyway, that's the dad jokes. Hope you enjoyed. Oh, sorry. Hold on. I'd be remiss if I did not do. That kid loves the dad jokes. All right, disclaimer before we get going. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. As always, I'm just some random guy on Facebook talking about things. Tonight's things will be bonds. You've probably noticed I generally don't discuss or talk much about investments at all. It's for a handful of reasons. One, not because investments aren't important, they are, but I think a lot of people give or overcomplicate the investment management, the investment picking process. So I don't want to be just another sort of talking head throwing more random noise into the decision-making process for you all to further confuse and convolute and complicate things. Good investment management has increasingly become cheap, easy, and commoditized. Now, I know there's a lot of asset managers out there who'll snicker when I say that and tell me I don't know what I'm talking about, but it's true. Not for everyone in every case, but in the large majority of cases, there's really no reason to use more than a handful of funds or individual investments. You don't need to get more fancy than that. So, plus also, I am a registered investment advisor. You know, that's my day job, if you will, and there's a not so fine line that I never want to cross. Anytime I start talking about investments or stock tips or anything like that, it could be misconstrued as advice or recommendations. Anything I ever say, there's disclaimers in the Facebook group, there's disclaimers on my YouTube channel. Anything said or read or written here is in no way specific advice or recommendations for you. It's all just general helpful hints and education. But nonetheless, investments, anytime you say anything investment related, people can kind of easily say, "Oh, some guy on Facebook seems to know what he's talking about, said that this bond XYZ is something good, so let me buy it." You buy that bond, you get burned. Now you may try to come back and point the finger at me that I recommended it to you. So anyway, so I try to steer clear of investments. Tonight we are going to sort of wade into that somewhat, but just to be painfully clear that there's zero recommendations or specific advice to any of you all here. This is just general education and information. So cool. Let me just see. Comments are working. Yes, comments are working. Okay, awesome. I see Cody gave a dad joke there. Good. David Myers getting bondy and nerdy. What's the duration of tonight's episode? to you, David Myers, my question is modified or Macaulay duration. Oh, you all. Well, I'll tell you what that means in a little bit. So let's get going about bonds. I'm not sure what to do with questions. This is technical. This is one of the more analytical things that I've done in terms of live. So maybe I'll sort of stop and take questions along the way. But I don't know. We'll see how this goes. I'm not really sure what to expect. This is one of the nerdier topics, definitely more quantitative topics. It's those of you who are interested, this may be a huge hit. For the rest of you, this could be a tremendous flop that you have no interest in watching. But we'll see. I enjoy bonds. Bonds are important. I worked most of my career prior to starting my business a year and a half ago in and around fixed income, not just bonds, but other fixed income products, things that have an interest rate component of some sort. I was also an adjunct professor at Rutgers University for 5 semesters so far, 4 for the MBA program, 1 for undergrad. All of them were finance classes. The first class I taught was analysis of fixed income. So all about bonds. What are they? How do you use them? What do they do? How to risk manage them, whatever. So I sort of have a sweet spot in my heart for bonds, having worked in the fixed income industry and taught about bonds for a couple semesters. I really enjoy this topic. I'm a little rusty from the academia point. I haven't had to drill into the nitty gritty of a lot of these things and like the formulas to calculate something called convexity. I completely forgot, but we'll discuss the principles nonetheless this evening. So let me get going. I have a few thoughts, some sort of ruminations I want to spit out there before we get into it. One is bonds. Most people don't know much about bonds, and it's not because they're not important. Like I said, the bond market dwarfs the stock market by multiples. And I don't have the exact metric. I did look this up when I taught this class like 10 years ago, but if you add together the value of every stock outstanding, it's market capitalization, the number of shares times share price. You do that for every stock in the world. It's going to be large. I don't know the exact number. I'm not even going to venture to guess, but it's large. Trillions of dollars. I'm guessing. You add up all the bonds in the world, and it's multiples of the stock market. So bonds are bigger. Bond is an asset class, are bigger than equities. It's a lot less glamorous, and there's a few reasons. You turn on CNBC. Well, bonds don't trade on an exchange. Some do, rarely though. Bonds don't trade on an exchange. Bonds are something you have to buy like direct from calling up a broker or logging on to an electronic broker and buying or selling individual bonds. I'm talking about bond funds are a different story. You can buy an ETF like a stock through a brokerage account or whatever, but to buy and sell like individual bonds, you can't, there's no exchange for that. Whereas stocks do trade on an exchange. So you turn on CNBC, and that's all just pomp and circumstance. Turn on CNBC, it's not coincidence that there's people, very pleasantly, attractive folks sitting at the stock exchange with these huge banners and TV screens and things flashing and, showing the floor of the New York Stock Exchange. And all day long, there's bunch of people talking about stock tips and news and Kramer's Mad Money, and there's even shows that are as silly as like Fast Money, literally a bunch of goons telling you how to make a quick buck trading options. Like, it's all this stuff just to feed into people's demand to want to see, to glamorize stocks and related investments, to make news when there is none. Anyway, so that's CNBC. You don't see the same for bonds. There is no bond market. There is no bunch of glossy flat screens and tickers flashing around all day. You'll see Rick Santelli on CNBC. He's kind of the bond guy, if you will. He'll talk about interest rates and futures and things like that. And they will show the yields, which I'll discuss what yields mean. They'll give the price and or yield of some of the major bonds like U.S. Treasury bonds. But outside of that, there's no kind of huffing and puffing and flash and sizzle and glamour about the bond market, which is why most people don't know about it. So that's kind of my rant there. So bonds are no less important than stocks. They're completely different. They function different. They act different. They have a different purpose and value, but they're no less important. And the bond market is larger than the stock market, but you would never know it by watching, spoon-fed garbage like CNBC. Bonds are also more logical to value, and their prices are confined, mathematically confined, whereas stocks aren't. Stocks can go to zero, as can bonds in theory. It's much less likely, but bonds can go to zero. Stocks can go infinitely high in price, and with seemingly no fundamentals or logic behind it. Just look at the quote unquote meme stocks of the last year, like AMC. I'm sure there's others I'm drawing a blank on. But stock price can double, triple, quadruple, tentuple, overnight over the course of a week, or whatever, for no seemingly good reason. But it can happen. There's no like mathematical confines to where stock price has to stop. Yes, there's historically agreed upon rules of engagement, i.e. fundamental valuation. Stocks should trade within a relative range of price to earnings ratio. I mean, the stock price should be no more than a certain amount of multiple of that stock's net income, basically. There's cash flow metrics. How much cash does a company throw off? There's book to value. Book value of a company. And there's all sorts of metrics, but they're all just sort of hypotheticals. At the end of the day, a stock market is one big fat auction. And like any auction, the price of something is going to be whatever the buyers and sellers agree it to be. No matter how illogical, the price could be whatever. If there's a buying and seller willing to consummate at that price, that's the price. Bonds are much more confined, which is why I like it. So think about this. Let me step back a little bit. And just keep this in mind with all these investments when you read all this nonsense news and tips about stocks, and think about it. Just doesn't matter. This stuff doesn't matter. It's noise, turn it off. About the difficulty of trying to value something to make sense of stocks and other types of investments. So when valuing an investment, you have to look at the investment's ability to generate money. Let's use US dollars, because that's the denomination of life. That's the currency of everything we do in this country is US dollars. And investments are nothing more than financial tools. You shouldn't buy investments for traditional financial investments. You shouldn't buy for emotional reasons. You shouldn't buy for other reasons outside of it's there to produce some amount of dollars for you. The further removed that investment is from being able to produce dollars in known frequencies and amounts and certainty you're actually going to receive it, the more difficult it is to value, because there's much more subjectivity in it. Think about this example. If I had a $100 bill, I'm standing right in front of you, and I ask you, how much would you pay me for this $100 bill right now, for me to give to you right here? You would not pay me more than $100. There's no logical reason why you would, right? You don't want to pay less than 100, of course. But I would logically not accept anything less than 100. It's $100. No more, no less. There's no deviation or variability about it. So that $100 bill right now is worth $100. That's the only price you and I would be willing to exchange $100 for. Let's start throwing some wrinkles in here. What if it's $100 a year from now? I say, hey, I have $100 you can buy from me. I'll give it to you in a year. How much are you going to pay me today for it? Now the answer is a little different. Now there's something called time value of money. Money is unique in that it can earn interest like other assets can't. So time value of money simply says $1 today is not worth the same as $1 tomorrow, because it can earn interest. So in order for you to have $100 a year from now, you can invest something less than 100 today. Let's just say $99. You can earn $1 of interest between now and a year from now, such that in a year you have $100. So that right there means if you're going to buy $100 from me, where I'm going to give it to you in a year, how much would you be willing to pay today? The answer should be $99 in my example. Because your alternative is you can take 99, put it in a bank. Over 1 year, it'll earn $1 of interest. I'm just making that up. Interest rates aren't that high. But anyway, it'll earn $1 of interest such that it's worth $100 in a year. So you have to factor in the time value of when you're going to receive the money. The other wrinkle here is my creditworthiness. What if I'm no longer around to actually give you that $100 in a year, whether because I die for natural health reasons, or I just, I'm a sketchy character and I just take off and I don't agree to pay you. So how much would you pay me now with that in mind for me to give you $100 in a year? The answer should be even less than 99. So you have to look at the time value. So that means your base price now is you're going to pay 99 for that, but also factor in my creditworthiness. If I'm a super sketchy cat, there's a really high chance I'm not going to show up and actually give you the $100. So you should now be willing to pay even less or the $99 for this $100, because there's a risk I might not be there to give it to you. So maybe that means you pay me only 95 or 90. You got to get risk reward. You have to get more compensated for the fact that you're taking on more risk, because I may not show up and actually give you this $100. So now things start to get difficult, as you can see, right? $100 right in front of you right now, it's 100% easy. It's $100, no more, no less. When there's time involved, when there's credit worthiness or lack thereof involved, you have to start trying to quantify these things, and different people will quantify them differently. The interest rate you assume you can earn over the next year may be different than what someone else assumes. So therefore, you too may come up with different answers as to what the time value is of my $100. And the credit risk is another thing. You may think I'm quite creditworthy. The other person may think I'm an absolute scumbag and is willing to, pay no more than $80 for this $100. You may be comfortable paying $90 for it because you don't think it's that risky that I'm going to skip town. Neither of you are necessarily right or wrong. It's just you have different inputs into what you're valuing this $100 receivable to be. So you can see how it starts to get complicated. Now, the further removed you get from being an actual tangible known cash flow, there's that much more subjectivity, guessing, and variability into the models. Like at one extreme, a piece of art. What is art worth? Who knows? It's worth whatever someone says it's worth. There's no fundamentals or logic. I mean, at a minimum, it's the wooden frame that the canvas is on. You can strip that down and sell that for 50 cents or something. It's purely kind of emotional value. It's scarcity value of some artist who died 200 years ago. He's never going to be able to produce something like this. But how do you put a dollar amount on it? There's no cash flows from it. It's purely just your own personal reason. Like, I got $100 million. I think this would look really nice in my bathroom. I'm willing to pay $5 million for it. That could just be a number I picked out of the air. Someone else, it's not worth more than 50 grand to them. Someone else is willing to pay $50 million for it. Right? It all depends. There's no discernible cash flows. So the further you're removed from known, safe, stable cash flows, the harder it is to value, because financial investments are all about just valuing cash flows. And then stocks are kind of somewhere in between. What cash flow does a stock actually produce? Well, stocks that pay dividends, there you go. You have a dividend stream. Now, dividends aren't guaranteed. They could be stopped at any time, but let's assume they're relatively stable. You get it every quarter. Then you have some idea of what your cash flow is, but that's just a dividend. The other big cash flow is when you eventually sell the shares, how much you're going to get. That's a complete guess. Nobody knows whether you maybe sell in a day, maybe sell in a year, maybe sell in 10 years. No idea. So how do you value what that stock is worth? It's impossible. That doesn't mean people don't try, but there's no scientific mathematical answer to this stock is without fail or without question worth X dollars. So I'm getting off on a tangent, but point is, there's a historically agreed upon rules of engagement that stocks that trade over a certain multiple or over some certain valuation are priced too high. The price has to revert back. Stocks that trade below or too low, the price has to come up. That's historically how active stock pickers have tried to make money, by playing fundamentals many times and whatever. But fundamentals don't always hold. I've read a great article in Fortune basically saying fundamentals are out the window and are never coming back. And to some extent, I think that's true. That's a debatable topic that's never going to be able to resolve. But anyway, so bonds have discernible known cash flows. So bonds are much more range bound than what their price is. Whereas stocks price could theoretically be anything, because there's no limit to how high some Yahoo wants to value it. All right, let me pause there for a moment and actually get into what a bond is now and start stepping through this. Let me just see quickly comments here. Dave Foltz, the recent projection for inflation adjustment for Social Security for 2022 is 5%. If inflation turns out to be that number, why hasn't the bond market adjusted for that number? Good question, Dave Foltz. So the bond market in the interest rate market is also sort of an auction-driven market. This is this CPI number for Social Security. And I'm getting a little ahead of things here, but Social Security is based on the actual observed, recognized changes in consumer prices as measured by the CPI. I don't know if it's W or U, I forget. But it's like the third quarter of last year versus the third quarter of this year. That's what the Social Security adjustment is. Now, in that inflation figure, there's things like lumber has gone up, housing has gone up, gas prices have gone up since the depths of the pandemic. I don't know if gas is included in the measure of CPI, but things have gone up. However, a lot of that could just be attributable to one-off isolated events like lumber. Lumber market's already coming back down to earth, but it got carried away like 3 or 4 times increase in price in lumber. Things like that. Those are all weird one-offs due to the pandemic and supply shortages and stuff like that. So yes, I don't doubt CPI is, I don't know, it was 5%. That was higher than I thought I heard, but whatever. That doesn't mean that it's going to be 5% forever. So the bond market doesn't necessarily believe that interest rates, inflation is going to rise that much down the road forever. It could just be viewed as an isolated 1-year thing as the effects of the pandemic kind of unwind themselves over the next year or so. Okay. I see Dave Myers here. So Dave Myers is going to have some phenomenal comments here. He was a bond quant in his prior life, worked at Solomon Brothers, who was kind of the cream of the crop of bond traders and analysts back in the day. So Dave definitely knows this stuff. I'll let you all read along at home his comments. I won't bring them up because they're probably going to be or potentially more technical than I want to take this. But anything Dave says, definitely listen to here. He potentially knows more than I do about this stuff. I like to think I know a lot, but Dave could be up there as well. So, all right, let me pull up got a little presentation here. What is a bond? Some of this will be super elementary. Just bear with me, and then it'll get a little more technical quantity. Where did it go? Hold on, give me a second. Pull this up like that. Okay, share screen. Yes. All right. What is a bond? So it's basically just debt. It's a form of debt or borrowing from either federal governments, state, local, municipal governments, corporations, etc. It pays periodic interest known as coupons. A bond used to actually, this predates me, I've never seen one in person, but a bond used to be a book. It was a booklet of actual coupons. You would tear off the coupon, mail it in to the issuer. The issuer would then send you, $50 or whatever the interest, aka the coupon, was, the periodic interest rate on that bond. It was called the bearer bond, meaning whoever was in physical possession of that book was the one who was rightly entitled to receive the payments from that bond, clip the coupons, mail the coupons in, get the payments for the coupon from the issuer. Now, I don't know if there's any, there may be, but practically speaking, I don't think any bonds are in physical booklet paper form anymore. Now they're all electronic entry, generally held by this global sort of brokerage pipe and plumbing system called DTC, but that's neither here nor there. They're still called coupons. The point is, the interest rate bonds pay is called coupons. So for example, a bond may pay a coupon interest rate of 5% per year. Just that's grossly high for current interest rates, but just to throw a number to it. Bonds also have something called the principal amount or face value or notional value that's paid at maturity. Let me just step through this quick. So let's say there's a bond that's a 10-year bond. A borrower, whether it's the U.S. government or General Electric or the state of New Jersey, the municipality, borrows money for 10 years, and they borrow $1,000 per bond. So they issue this bond that says, hey, you give me $1,000 today, I will give you an IOU. The IOU says every year for the next 10 years, I will pay you $50 in interest. Let's assume that's a 5% interest rate on your $1,000 bond. And at the end of the 10th year, I will pay you back that initial $1,000, that initial principal. So in this case, the $1,000 would be the principal, the $50 or 5% annual coupon rate would be the interest, and then the maturity would be 10 years. After 10 years, when the borrower pays that principal back, the bond is over. It expired, it terminated, it's done. It doesn't exist anymore. So now once the initial issuance happens, that bond, that IOU, if you will, the right to receive those future payments can be bought and sold throughout the market. So a typical process is, let's use a corporation, General Electric, not saying they're good or bad, they are what they are. General Electric wants to raise some debt, wants to borrow some money, and it does it through a bond. It'll go to an investment bank like a Goldman Sachs and say, hey, I want to borrow $500 million in total through a 10-year bond. Each individual bond will be $1,000. So that's what, 500 million divided by 1,000. Do the math. I don't know what it is. Goldman Sachs, it'll be a 5% annual coupon rate. Goldman Sachs will say, cool, we will buy it all from you. Here's $500 million. Give us all the bonds. At that point, Goldman Sachs then is the one who has the right to receive those annual coupon payments and those principal repayments at the end. But Goldman Sachs isn't going to keep most of this, if not, none of it. They will then turn around and sell it to the market. They'll sell it to you and me. They'll sell it to institutional investors like mutual funds, hedge funds, sovereign wealth funds, insurance companies, pensions, endowments, retail folks like you and I. We can go buy these bonds. So the point is, these bonds can be bought and sold in the market, right? You still have an IOU from General Electric when you buy this bond, and General Electric is the one who pays you. But you're free to buy and sell this bond to whomever during that bond's 10-year life, its 10-year maturity. Sort of final comment for now. many U.S. Treasury bonds you can actually buy direct from the government. There's a site called treasurydirect.gov. You can buy a Treasury bond from them, but most other bonds you have to buy through a broker. Corporate bonds, municipal bonds. You have to call up, whether it's Schwab, TD, Fidelity, Vanguard, whatever. You can buy bonds through them, individual bonds. Bonds, if you were to buy individual bonds, it's kind of clunky. There's almost always going to be a commission, could be upwards of $50 per trade, per bond. For the vast majority of folks, it's probably much easier, cleaner, more efficient to just buy bond funds, like a bond mutual fund or a bond ETF. That's literally, buying an ETF is like buying a stock. You go onto your stock account at Ameritrade or whatever, buy this ETF. That ETF in turn owns hundreds, if not thousands, of bonds. Now it's slightly different. I won't get into it here. I did a separate live about bonds versus bond funds, pros and cons. When you own a bond, you know exactly the cash flows you're going to get because you have your coupons every 6 months, every year, whatever, and then your principal repayment. When you own a bond fund, there's hundreds or thousands of bonds in there kind of coming and going. Bonds are maturing, they get replaced by new bonds. So the cash flows are much more unknown with a bond fund, like a mutual fund, as opposed to individual bond. But practically speaking, for most people, buying a bond fund is probably the easier way to do it. Okay, what's my next comment here? This is getting a little academic, but I think it's helpful to understand, just so you can visualize, conceptualize what a bond actually is. When you're a company, all companies have assets. Assets are things like cash, accounts receivable, inventory that they own, equipment like machines that make things, and then buildings and land that they own. Well, how do you get the money to actually buy your assets, to buy the things you own? Well, it comes from one or a combination of two things, either liabilities, borrowings, debts, or equity. So if you, let me just start walking through this. The liability and equity is called the company's capital structure. The capital structure is what's used to buy or finance the assets that are owned. Common examples of liabilities are like an accounts payable. They bought inventory, they have to pay someone for it. They take a loan from a bank or bonds. This is where bonds fit in, and this is a company. You can sort of think of this as the same for governments, but we're just thinking about like a corporation for now. So a corporation can issue bonds, basically take a loan, an IOU, by the way of issuing bonds. That money is used in part to buy inventory, to buy equipment, to buy buildings or land. Or the other alternative is the company can issue stock. This is where stock fits in. Stock is another part of a company's capital structure. A stock, big difference between a stock and a bond. A bond is just a liability they have to repay. They have a contractual obligation to pay this bond off, pay its coupon on time, pay its principal on time, whatever. Equity is what's called permanent capital. You don't have to repay, especially common equity. A company will raise stock. They'll say, hey, we're selling off shares of ourselves. We're selling off slices of ownership of ourselves for $50 a share. When they have that initial, called initial public offering, they will get all that money in from the share sales. They now gave up equity ownership of themselves to everyone who bought those shares, but in return, they got $50 per share, hundreds of millions of dollars from this total raise. That's permanent capital. They don't have to pay that off. That's what they got for giving up slices of ownership in the company. So anyway, so this is where common stock fits in. This is permanent capital. When the funds are raised from stock issuance, those funds could be used to build a cash pile, to buy inventory, to buy equipment, to buy buildings and land, just like they can instead borrow money by way of bonds to buy this stuff. Make sense so far? So anyway, this is more of like investing 101. This isn't specific to bonds, but I thought it's important to realize kind of where bonds and stocks fit in. One final thing before I get onto bond pricing. I will get there, I swear. Let me take a drink first. I'm talking a lot, kind of parched. Oh, I just spilled. I'm an absolute slob. Other important thing to know. So, there's water on my desk. Takeaway from here is when you own a bond, you're just a creditor. You lent money to a company, maybe not directly because you bought the bond from someone else. But the point is, you're a creditor. They owe you money. Once they pay you off, they're done. You have no other claim to them. They have no other obligation to you. When you own stock, you're not entitled to anything. They don't have to pay you dividends. They don't have to pay you any cash flows. while you own that stock. You just simply own a share of the company. What's that worth? It comes back to my point of like, how exactly do you value what precisely you own when you have a stock, when you have a share of a company? This next slide will help you think about that some more. So this is a little technical, but if and when a company goes bankrupt, it becomes insolvent and it has to close up shop, right? It's no longer a viable going concern. It has to just close. It has to basically pay off everyone it owes money, and then blah blah blah. So here's the order in which things are paid off. So a company goes bankrupt. They have to liquidate. They have to sell off what they have. Whatever's left gets paid out to the shareholders, and then the company's kaput. So first they pay off secured creditors. Secured just simply means like if you lent them money and that money was specifically, or the repayment of that money was specifically tied to something like a machine. Like there's secured notes where you lend a company money, $50 million, and you lent specifically for the purposes of them buying some big piece of machinery. Well, you're secured by that machinery, perhaps. So if and when the company says we ran out of money, we can't pay you anymore, guess what? You can take that machine. You now own it. You can sell it. Whatever you get for it, you can use that to pay yourself off. That's called secured creditor. After the secured creditors are paid to the extent of the security they have, then there's unsecured creditors, those that don't have a specific thing pledged to them. And this is the order in which people are paid off. The administrative costs and expenses of the liquidation itself are first priority. So I guess like the legal costs, court costs, whatever. Then claims for wages and salaries. So the people who work there, to the extent they're owed like back pay, the company was late paying wages, they're next in line to get paid from whatever the company has left. After that is taxes due to the federal or state government. If and when there's still money left, then bondholders come into play. So if you own bonds, next you'll get paid off if the company has any money left after paying off all these things above it. Only if and when the bondholders are then paid off, the stockholders get the scraps, if any, of what's left. So this is why people talk about risk return. This is one of the big reasons why stocks are that much riskier than bonds, because if and when the company defaults, blows up, can't pay off what it owes, bondholders get paid out first. Only if when bondholders are paid off do the common shareholders get anything. Let me leave that there for now. I mean, I can ramble about this for a while, but I'll stop that there. All right, and this gets back to I'm rambling again. This gets back to my point of like when you own a stock, what exactly do you hold? Like, what are the cash flows it's going to give? Especially for a stock that doesn't pay dividends, you can think about this. This is your ultimate cash flow, is if and when the company were to go belly up, you get whatever's left after everything else gets paid off above you. That's like the actual value of the company, if you will. That's called the book value, more or less, of shares. So that's one way to think about it. Like this is the cash flow you'll actually receive from the stock, is only if and when the company goes bust, you get paid what's left. Now, practically speaking, stocks you can buy and sell in the market. You can simply sell it to someone else. That's how you can get out. You don't have to wait for the company to go bust and formally liquidate to get your money back. You can just simply sell it. But again, that's one big auction. The price at which you're going to, buy and sell is whatever the market participants agree to, which could be extremely irrational for a very long period of time. All right, moving on. I don't want to keep bashing stocks here. Okay, so let me now pull up the spreadsheet and just start showing you how bonds are actually valued. Give me a moment. Go away. There it is. Okay. Share. Window. Plop. Share. All right, here we are. I made up a little spreadsheet. Should I zoom in? Yeah, good enough. Okay. So here's a bond. Here's how bonds are actually priced and valued. Here's what a bond looks like on paper, if you will. So let's assume you have a bond. It's $1,000 bond. So every bond, the company borrowed $1,000 initially. They agree to pay back $1,000 to each bondholder. And let's assume it's a 10-year maturity. So at the end of 10 years, they pay that $1,000 back. And just for clean numbers, let's assume there's a 5% coupon rate, which means $50. And I'm assuming an annual coupon. In practice, most bonds pay coupons twice a year, semi-annually, but there are some that pay annually. I'm assuming annual to keep the math simple. So let's assume every year you're going to get a $50 coupon. That's just simply 5% coupon rate times your $1,000 par value or principal value. Discount rate, don't get too hung up on that yet. And I just want to show you, this is what your payments look like. So here's the 10 years of this bond. In year one, you're going to receive $50. This is just simply your coupon rate of 5% times your $1,000 face value or par value. So $50. And then every year you get your $50 coupon payment. In year 10, you get that $50 coupon payment again, and you get the $1,000 principal repayment. So if you were to buy this bond today, the bond was just issued, these would be what your cash flows are. $50 per year, and in the 10th year, you're also getting a $1,000 principal repayment. This is why I say bonds have a mathematical cap of what the price can be. You're never going to see this bond trade for like $10,000. It simply can't, because you know with certainty at most what the total cash flows are going to be. It's the sum of your 10 coupon payments plus your $1,000 par value. This is simply $1,500. If you add these all up over the life of this bond, you will receive no more than $1,500 at most if you hold this bond till its maturity. Therefore, the price of this bond can never fundamentally, logically, reasonably ever exceed $1,500. It has to be something less than that. And then the reason why I say it has to be something less is because of the time value of money concept again. This is what this column is. So now this is what the discount rate comes into play. Present value is simply just you take each year's cash flow, so $50, $50, blah, 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 and then $1,050 in year 10, and you just simply figure out in today's dollars, what's that worth? And you do that by basically backing out what the interest could be you could earn every year. So let's look at year one, for example, and let's assume your discount rate is 4%, meaning like the rate of interest you can earn for holding something for 1 year is 4%. That means $48.08 today. If you invest it and earn 4% for 1 year, it'll be worth $50 in 1 year, right? Does that make sense? So you have some amount now, add interest to it over a year, it's worth some larger amount. Well, you can do the process backwards. You can start with the larger amount and what's called discount it back to the smaller current amount. That's what this column is. So this column is just simply discounting or present valuing every one of these future cash flows back to a time zero, back to a today value, and it's discounting at 4% per year. So a bond's price is nothing more than the sum of the discounted present value of all of the bond's future cash flows. So again, this is the actual amount you receive in each of these years. This is the today value, the discounted, the present valued amount of each of those 10 cash flows. Simply sum them up. That's your $1,081. So today, if you were to buy this bond right now, had a 5% coupon, but the market level of interest rates is only 4%, you would be willing to pay, or you should pay, $1,081 for this bond. Let me leave it there for now. It's even going to work, right? And if there's no time value of money, remember I said the terminal value, the maximum price this bond could possibly be, should never exceed the simple sum of all of its future coupons and principals, barring any time value of money. So I'm making the discount rate 0. The price of the bond is $1,500. There you go. It's just a simple sum. The present value of each of these is the same as the future value. I feel like I'm probably losing some of you now when I start talking about this future value, present value thing. But for those of you who are interested in financial math and bonds, hopefully this is making some sense. Okay, so let me pause there, collect my thoughts, and let me take quick comments. I will come back to this. I'll take it off screen share for now, but let's just see what kind of comments we got. Dave Myers used to go with his grandfather to cut coupons and turn them in. Okay. David Fultz, when a company offers a 100-year bond, who purchases those type of bonds? Yeah, great question. So it could be anybody, but usually it's going to be like insurance companies, people who have longer dated liabilities where they want to buy some longer dated assets, such as a 100-year bond, to pair it up. So insurance companies are in the business of having long dated anticipated cash flows, liabilities. They're long dated liabilities like life insurance policies, for example. Someone who's in their 20s buys a 30-year life insurance policy. The insurance company has to project, okay, we might be making a payout for this thing in 30 years. Or pensions. Insurance companies often manage pensions as third-party managers. Pensions can last for decades, right? Someone retires at 55, lives to 100. There's 45 years of pension payments this insurance company is going to have to manage to. So they want these longer dated assets like 100-year bonds because they know what the payments are going to be for 100 years. Now, maybe the bond will default along the way, maybe not. And the insurance company will price that in. But typically, like insurance companies and the like, people who have long dated liabilities that they want a long dated asset to pair it up with. Good question. David Myers, yeah. So preferred stock is basically like a bond, infinite bond. Preferred stock doesn't mature; it runs forever. It has a coupon, if you will. That's in effect, it's a dividend, but it's practically a coupon. Okay, I'll leave it there. June, is the discount rate equal to bank interest? Will discount rates change every year? Yeah, interest rates. I mean, interest rates are one of the hardest things to comprehend. People generically say interest rates are going up. But what does that mean? There's so many different interest rates that all do different things, that have different impacts and different uses. It's far beyond the scope of tonight's video to discuss what exactly the discount rate is here. I'm gonna attempt to mention yield to maturity and things like that. But no, it's not bank interest. Deciding what rate to use as your discount rate for any instrument, there's a lot that goes into it. The timing of the instrument, the riskiness of the instrument, it all depends. I'll have to leave your question there, June, because this will quickly spiral into a whole multiple hour discussion about interest rates and things like that. So I'll stop it there. Sorry, but that is a great question. But no, bank interest is very different. Bank interest, like the interest rate you get in a savings account, is what it is. It's stated by the bank. Boom, it's done. These yields, these discount rates are very different. So let me try to explain what these are now. A great segue, actually, because I was about to get into that. Okay, I don't know who this is, but thank you. Cool. Back to screen share. Back to this painful academia lesson. I enjoy it. I mean, this is my bag. Hopefully you all are enjoying it. Okay, so now yields. How do I explain this? When this bond was newly issued, let me just show. I made this like you can do this for different years. You can do 1 year, 2 year, 5 year. Anyway, let's stick with 5. Let's stick with 10 years. You can still see this on the screen. So when this bond was issued, let's assume that the market demanded interest rate or yield at the time was 5% for a 10-year bond like this. So the market environment of interest rates on 10-year bonds was 5%. Therefore, the bond would have set its coupon at 5%. It would have been the market level of interest rates at the time. So when this $1,000 10-year bond was newly issued, it would have set its coupon rate at 5 because the market demanded discount rate / yield / interest on the bond was 5%. Therefore, this bond would have been sold for precisely $1,000. Keep it simple. There's more to it than this, but this bond would have been sold for $1,000 at its initial issuance. And it has something called a duration. This is a little out there, but it's important to understand. I won't get into the math of how duration is calculated, but just know the duration for this bond is 7.7. There's lots of ways to think about duration, but again, beyond the scope of this. The way to practically interpret this is that if the market level of interest rates were to change by 1%, so they go from 5 up to 6 or down to 4, for example, this bond's price will change by approximately 7.72%. Okay, let's see this in action. So again, this means a duration of 7.72 means if the market level of yield of interest rate demanded for this bond goes up or goes down 1 percentage point, this bond's price will change by about 7.72%. So currently the bond's price is 1,000. Bond yield, the market yield, the market required interest on this bond were to go up to 6 after this bond was issued, we're going to expect the bonds price to drop. Bonds price dropped to 926. So that is, how much of a decline is that? 926 divided by 1,000. So it dropped 7.4%. Recall the duration was 7.7. Again, this bond, we would have anticipated a 7.7% decrease in price if interest rates went up 1%. The bond actually decreased 7.4%, so pretty close. I'll explain why it's not exact. Hold that thought. But where I wanted to go with this is that this is a 10-year bond, has a duration of 7. Again, it means that interest rates move by 1%. The bond's price will change about 7.7%. What if it was a 30-year bond? The duration is 15.37. This means the way to interpret this is if this bond's required interest rate after the bond was issued were to go up by 1%, the bond's price would drop about 15.37%. So let's see this in action. This bond is originally priced at 1,000. Market interest rates go from 5 to 6%. This bond's price dropped to 862. 862 is a 15.8% drop in price from where the bond was. That's not cool. Let's look if it's a shorter term bond, like a 1-year bond. The duration is 0.95. That means that if this bond's interest rate were to, the market required interest rate were to go up or down 1%, after this bond is issued, this bond's price will only change by about 1%, 0.95%. That's not bad. Where am I going with this? This duration is important because a bond's price will go up or go down as interest rates go down or go up. Bond prices move opposite the direction of interest rates. Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. Duration is the metric you can use to estimate how much a bond's price will go up or go down for a given level change in interest rates. Let me restate that or reiterate that. Duration is an estimate of how much a bond's price will go up or go down due to a given change in interest rates. Cool. So like now, for example, we are coming off historically low levels of interest rates. The risk is asymmetric that interest rates will potentially go up much more than they can go down from this point forward. So you probably want to stay away from bonds with large durations, like 30-year bonds, because a given change in interest rates, when rates go up, will have a big drop in price for this bond. A 1% change in rates on a 30-year bond will mean the bond price will drop like 15%, whereas a 5-year bond, for example, a 1% increase in interest rates would only drop the bond's price about 4%. I'll pause there. Now, if you hold the bond until maturity, the bond's price change along the way doesn't matter because at maturity, you will get back the $1,000 in this case. This bond price change really only matters if you don't plan on holding the bond until its maturity and you plan on selling it along the way. This also matters for bond funds because bond funds may not hold bonds till maturity. They may cycle bonds in and out. So they may be selling bonds before they mature, in which case the duration, the interest rate sensitivity of the bond price is something you want to pay attention to. Okay. Now how I'm trying to explain. So what is yield? In math terms, the yield is simply the rate, the discount rate you have to back into to get the bond's current actual price to equal the present value of all of its cash flows. Let me say it another way. The yield to maturity is the discount rate you would use to get the present value of all the cash flows to be equal to the bond's current price. So my spreadsheet, I have, you can change the yield and see what the price is, but this can also work backwards. So for example, if there was a bond that had $1,000 par value, matured in 5 years, pays a 5% coupon, and it's currently trading in the market for $958 per bond, you can do this math in reverse. You can back into what interest rate, what discount rate is being implied to come up with the present value of all these things such that the present value of these equals the bond's price of $9.58. That's what yield means. That's yield to maturity. And that's how bonds are quoted. The interest rate on bonds, other than the coupon rate, the current level of interest you can earn on a bond, if you will, is quoted as its yield to maturity typically. Some complex stuff for those who haven't been exposed to like the math or the academia behind yield to maturity, but that's basically what it is. So June, this is a kind of sloppy way to answer your question. No, the discount rate, aka the yield to maturity, is not just the bank interest rate. Very different than the interest rate you get in your savings. The yield to maturities are dictated by the market. So let's look at, I have another slide here to try to make sense of what yields are. Hold that thought. I will do this. I will swap this around and I will minimize this and I will go back here. Okay. Yield curve. What is a yield curve? So using US Treasury bonds, for example, bonds with maturities from 1 all the way up to 30 years, these are the market implied, the market demanded yield to maturities for each of these bonds. Let's start with 2 years ago. This blue curve, this blue line represents what the respective yield to maturities were for each of these maturities as of June 21st, 2019. So for example, if you bought a 5-year a US Treasury bond maturing in 5 years, this was 2 years ago, the yield to maturity you would have got would have been, what is this? We'll call this 1.7% or 1.8%, let's say. This is actual data taken from treasury.gov. So 2 years ago, 5-year US Treasury bonds, if you would have bought a 5-year bond at the time, you would have got about a 1.8% yield to maturity. Then the pandemic happened and yields dropped 1 year later. So June 22nd, 2020, where's my mouse? There it is. This was now what the yields were on various maturity US Treasury bonds. The 5-year US Treasury bond at the time, June 2020, was only, we'll call this 0.35%. So it dropped from 1.8-ish to 0.35 in the course of a year. And then fast forward to yesterday, June 22nd, 2021, if you were to buy a 5-year Treasury bond, you would have gotten a yield of about, 0.9%, we'll call it. So these are the yield curves. So as of yesterday, let's focus on this gray graph now. If you were to buy a 5-year Treasury, the yield to maturity that you'd get if you held this a 5-year bond until it matured would be about 0.9%. A 10-year US Treasury bought yesterday would have gotten you about 1.5% if you bought and held it to maturity. And a 30-year would have got 2.05-ish. So where do I want to go with this? So these are for Treasury bonds. These are the interest rates you want to be aware of, you want to pay attention to. It's the yields to maturity. And the yield curve is simply just a graphical depiction of all the various maturity of US Treasury bonds. What are their respective yields to maturity if you were to buy that bond today? That's what these curves represent. Again, this is the curve as of 2 years ago. This is the curve as of 1 year ago. This is the curve as of today. Okay, let me stop it there for now. There's a lot of ways I can go with this. Any comments, questions for this? Let me pause. Let me take this off screen share and just see. Comment here. As a bond trader for a bank for the last 35 years, I commend you for the ease of explanation. I trade tax-free bonds and I've given dozens of presentations. Mine are never this good. Well, thank you, whoever this is. Greatly appreciate that. I like to think I can take complex things and make them, digestible and understandable, which is why I like to think I got good reviews teaching, and why I enjoy stuff like this, these lives. I really dig doing this stuff. So thank you, whoever this was. I appreciate this. Am I the only one who finds the terms yield and duration not very reflective of what they mean? No, you're probably not, whoever this is. Yield sort of makes sense. If you think about yield in the general English sense of the term, it's like, what does something produce? Like, how much you have a field of crops. How much harvest can it yield? Yield is how much can it produce. Yield in the bond sense is really it's financially how much will this bond return or produce for you if you hold it. And yield to maturity means you buy this bond today, hold it until it matures. You will get an annualized return, if you will, of the yield to maturity. So let me just I have the actual yields as of today. Oh, come on, man, where is it? Oh, I got to minimize that. That's why. Sure. So this little table up here is as of yesterday or today, I don't remember. But these are, if you're curious, what U.S. Treasury bills, notes, and bonds are actually yielding. If you were to buy a 1-year U.S. Treasury bill today, you would yield 0.08% if you held that thing for 1 year, right? Effectively zero. If you bought a 2-year Treasury bill today or note today and held it for the full 2 years, you would get 25 basis or 0.25% return per year. That'd be your yield. That's what it returns to you. And then 3-year, 5-year, 10-year. 10 years kind of the benchmark you use throughout many things in finance. If you bought a 10-year U.S. Treasury note today and held it till it matured, you'd get about 1.49% per year return. And the 30-year bond, not much better. You get barely over 2% yield return per year. So whoever posted this, the reason why yield isn't just interest, because the yield takes into account the interest payments you will get and the principal repayment you'll get and the amount you pay today to buy the bond. So you throw all these things in a pot and cook it. The yield to maturity is again, the yield is the rate that makes the present value of all your future cash flows equal to the price you paid today. So yield isn't just interest. Yield is also any implied gain or loss you're going to have on the bond, meaning the price at which you bought it versus the principal amount you'll get repaid at the end. Yield captures all those things, which is why it's a squirrely, difficult topic to understand until you really dig in and think about it and go through lots of these mathematical valuations for it. Okay. David Fultz, duration is actually more right than it sounds. If you do the math, the units, it results in time. Yes. So Macaulay duration, I don't want to get this technical, but yeah, something called Macaulay duration. The units is time, if you will, years. Modified duration, which is the measure of duration you use to back into expected changes in bond prices, is no longer unit years. It's this bastardized unitless thing. It's basically years divided by yield. What does that mean? I don't know, but it produces a number that I know how to interpret. So anyway. Why would someone purchase a bond with a negative yield? Yeah, good question. In general, I mean, I wouldn't, but sometimes you don't have a choice. So interest rates are on short-term instruments and maybe in long-term instruments are negative and have been for a while in Japan and parts of Western Europe. And even cash, I think, was negative. That implies whereas you normally go to a bank, they pay you interest. This implies you pay the bank interest for the privilege of them holding your money. Why would anyone do that? Well, think about institutional investors, Dave Fultz. You have hundreds of millions of dollars that you may have to park in cash because you have an investment mandate that says you do, like a pension, like an endowment, whatever. You have a big boatload of cash that your investment mandate says you have to put somewhere safe and stable. You can't put $100 million cash under a mattress. That'd be dumb and dangerous. So you have to put it into a financial institution of some sort, whether it's a bond, a bank, whatever. And even if interest rates are negative, well, that's the price you pay for the safety and stability of having your money somewhere as opposed to in a coffee can or in your mattress, right? So that explains or that's one of the reasons why, especially in the institutional investor world, if and when short-term interest rates are negative, yes, they will lose money on their cash for the benefit of putting it in a bank or putting it in a short-term government bill, but they have to. It's the only place to put that. You can't put $100 million cash, in their mattress. Hopefully that makes sense. Or like Dave Fultz says, deflation. Right. Okay. So got ahead of myself. Or reserve requirements. They have to bank it, park it somewhere. June, is it right that the higher the yield, the more return an investor gets? Yeah. Yield to maturity. So yield to maturity implies if you buy this bond, hold it until it matures, you will realize that yield to maturity along the way. So in that case, yes, all else equal, the higher the yield to maturity, the higher the return you'll actually get if you hold that bond to maturity. The big caveat is, what if that bond issuer defaults? So you buy a 10-year bond today from General Electric. It's yielding probably like 2.5%. If you hold it to maturity, yes, June, you will annualize 2.5% return per year. But what if General Electric goes bankrupt in 5 years and they flat out disappear? You may not get paid anything back, in which case your yield's going to be very, very negative. There's no guarantee with this stuff. So barring default and not getting paid back, June, yes, higher yields to maturity mean you will actually realize that. Now, the reason why I'm emphasizing yield to maturity is that if you sell the bond along the way, you're going to sell it at some whatever the price is going to be at the time, and that price may be lower than what it originally was, such that you may actually have a loss on that bond. So the yield to maturity at which you buy the bond may not actually manifest itself if you hold the bond, if you sell it prior to maturity, June. Does that sort of make sense? Yeah, I'm afraid tonight's out there, but hopefully you all are digesting at least some of this. I'd be happy to do this again at some point. Oh, hey, Mavis. I wonder if we need to re-register on StreamYard. Our names aren't showing with our comments. You might. I frankly don't know exactly the interconnection between Facebook and StreamYard. Yes, maybe you do have to re-opt in every time, or at least every few times or something. I don't know. But yeah, if you do want your name shown, maybe you would have to opt in at this point. And there should be a post under this post within the Facebook group. I think there should be some pre-canned comment from me saying, hey, if you want your name to show, you can opt in. Can you call a yield curve a coupon rate curve? Depends. June, I'm curious. Do you have any fixed income background? Because this is a question I wouldn't expect an average person to ask. So there's different yields. There's spot rates. There's par yields. I don't know what's going through your head right now when you're asking this, June. So no, coupon rate curve. I don't. There's potentially more to this question. So I'll avoid the question for now, June. But I guess if you want to call it that, I don't think in practice anyone will call it this, but yes, these are coupon bonds we're using. You can call it coupon rate curve if you want, but I don't think anyone in the industry would know what you're talking about. But there are different yield curves for what it's worth: par curves, spot curves, CDFs, swap curves. Anyway, what is distribution yield? It's a good question. What is distribution yield? You don't know. That might. I'm just guessing. I mean, maybe I don't know if this is an SEC defined term or if this is like one particular fund issuer uses it. It's probably, you'd have to look it up. It's probably the factoring in all of the cash flows that bond fund's going to give you over the time, which will be passing through coupons that the underlying bonds pay, and any principal gain or loss that might get passed through to you. That might be the distribution yield, all rolled up into one pretty metric, perhaps. Great question. Okay. Oh, Cody, good point. So June, why is this not showing? Oh, there we go. Oh, yeah. So June, you may have been referring to coupon rate and the yield rate. So yeah, the yield doesn't have to equal the coupon rate. When, as I mentioned before, when the bond is first issued, the market level yields to maturity for instruments like that will dictate what the coupon rate is. So if the market yields at the time are 5%, then yes, this bond will be issued with a 5% coupon. Well, let's assume that. So once that 5% coupon is fixed, that's done. That's not changing for the life of the bond. That's contractually embedded in this bond. It will always be 5% for the life of the bond. But what if interest rates drop over time? So fast forward a year, the market level of interest rate, market participants at that time would only require a 4% return, a 4% yield on a 10-year bond. So that means the bond price is going to go up. And conceptually, this is why. So if you have a bond that's throwing off 5% coupons every year, and the market level of interest demanded is only 4%, someone should be willing to pay more than $1,000 for that bond because they're going to be getting paid 5% per year in coupon, right? So they're going to pay more than $1,000 now to receive higher than market level coupons, But there's no free lunch. They're only going to get $1,000 back when this bond matures. But while it may seem great that they're getting 5% coupons every year when the market level interest is only 4%, well, guess what? They paid $1,081 to buy the bond and are only going to get $1,000 back. So they're going to lose $81 in principal value, if you will, for buying the bond for $1,081, only getting $1,000 back, and along the way getting $50. So I'm not sure I'm going with that, June. But all these things tie together. But I guess to Cody's point in response to your question, yield does not have to equal coupon. When the bond is first issued, they typically do equal. But after that, coupon is fixed. Yield is going to be whatever the market demands it to be. Could be higher, could be lower, could be the same coincidentally, but it rarely is identically the same. All right, just before we, oh man, it's after 9. Before we wrap, I just want to give one more thought, circle back about duration, something called convexity, dun, dun, dun. So remember the example I gave where this 10-year bond, when it's first issued, has a modified duration of 7.72. The way to interpret this is if interest rates, if yields to maturity move by 1 percentage point, so up to 6 or down to 4, this bond's price, we would anticipate a change of about 7.72%. But remember the math I did, the actual change in price was something different than 7.72%. It was close, but it was different. Why is that? Well, duration, if you use duration to estimate a change in a bond's price, it's going to give a linear estimated change. In actuality, bond prices don't change in a linear fashion. The larger the change in the interest rate, the more deviation the bond's price change will be from that linear expectation, that linear prediction. That's due to something called convexity. And I won't get into the math of it now, but basically because there's exponents involved in this present valuing, that means that the actual change in bond price is going to be exponential. It's going to be a convex line, not a straight line. So let me show you. Oh, I already have it up. Look at that. Convexity. So here's a quick graph. The x-axis is yield. The y-axis is bond price. As we discussed, if yields increase, bond price will decline. That's this blue line. The higher the yield, the lower the bond price, and vice versa. As yields drop, bond prices rise. This blue line is what the price change estimation would be based on using duration. That 7.72 figure we had in our little example. So it's a linear estimation of change in price. In actuality, the bond price change will be something like this. So let's assume this is 5% yield right here when this bond was first issued. If the yield goes up to 6, duration would estimate the bond's price would be here. Let's widen this out. If yields go up to 10, let's say, duration would estimate the bond's price would be this, which would be here on the y-axis. But in actuality, the bond's price would actually be along this curve, this convex curve. So the price would be this. I'll stop there. Anyway, it's just important to know, I guess, if you're really interested in bond math, duration will let you estimate a bond's price, but it won't give you the actual change in price because there's this phenomena of convexity because bond prices don't change in a linear fashion. They change in a convex fashion. All right, I'll stop. I feel like I completely overwhelmed all of you. I can see there's 37 sets of eyeballs, which is about a third of what it normally is. I was not surprised by that. But anyway, questions. So I'm done blabbering for now. What other comments? I will hang out another handful of minutes. I don't see any questions currently, but I know we're on like a 15-second delay. What is it? Let's see what Cody has to say. I think there's a common misconception about the change in interest rates affecting the bond's price. If held to maturity, the bondholder still receives the stated coupon and par value at maturity. The change in bond price only affects those who will sell before maturity, correct? That is correct, Cody. Unless, again, the bond defaults along the way and you get skunked and don't actually receive all those cash flows you were banking on. But yes, that is true. If you hold the bond to, that's why yield to maturity is called yield to maturity. If you hold the bond to maturity, the price will change along the way. Maybe you bought the bond at $1,000 when it was first issued, and it's a 10-year bond, so you'll get $1,000 in principal value back. Along the way, as interest rates go up and go down, the bond price may fluctuate. 1,100 may go down to 900, may go down to 800, may go back to 1,000, blah, blah, blah. Along the way, the bond's market price will have to revert to its par value, because otherwise there's an arbitrage, right? If you are 1 day away from maturity and that bond's going to pay $1,000 principal repayment in 1 day, there's no logical reason why the bond should be trading for $1,100 or $900, because in 1 day they're getting $1,000. That's it, and the bond is done. So whatever price changes happen along the way, they all have to revert and hone in on par value at the time. But yes, if you hold the bond to maturity, assuming it doesn't default, you will realize yield to maturity. Change in bond price doesn't matter. It will affect the value of your assets along the way, but you will get your principal value back at the end. All right. I see Dave Myers has a thick comment here. I won't bring that up, but June, thank you. Okay. Great. Thank you, June. So found hard to understand, but I explained it well. I appreciate that very much, June. Thank you. Bonds are really tricky. As you can hopefully see now from tonight's really condensed session, bonds are much more complicated animals, pricing-wise, valuation-wise, than stocks are. Stocks are just, whatever the market says they are, that's what they are. People do make a lot of effort to try to understand fundamentals and blah, 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 and stock pick, but it's all just nonsense in my opinion. Bonds have some real science behind why they trade and why they're priced at what they're priced. And finally, this is so useful. Awesome. Thank you. Hopefully listening. I thought about this. I know I don't have a podcast, but a lot of people I think watch these YouTube or listen to the YouTubes to hear the audio after the fact. Tonight's one's going to be a hard one to soak up through an audio format, but good luck to whoever you are listening to this. All right, I see that's it for comments. Other than Dave Myers, June, and a handful of others, I probably bored you all to death. So thank you for sticking with me. Next week's topic is back to the usual sort of taxes and retirement stuff. It'll be all about what is and how to do backdoor Roth IRA contributions. Super exciting. And then week after that, we'll be joined by the man, the myth, the legend, Roger Whitney of the Retirement Answer Man podcast and the Rock Retirement Club. He will be joining to speak about steps you should take as you near retirement. Super interesting. A lot less technical than this, but I think you'll all find it extremely, extremely helpful. So that's it. That's it for bonds. Hopefully you enjoyed it. Thank you all for sticking with me, and good night. See you next week.